The U.S. Federal Reserve's annual bank stress test will be released this Friday. It's a tool used by the U.S. Central Bank to measure if lenders have adequate capital to absorb losses, in particular in a recession. Let's find out more. We're joined by Mike Clare, Senior VP and Senior Portfolio Manager at Brompton Funds. Great to see you.
Great to see you as well.
Just remind us, so that's the goal, in particular in a recession, how these banks would hold up. That's what the scenarios they run.
Right, and it also actually feeds into their capital requirements. So what the Fed does is earlier this year, they put out an adverse scenario for the economy. They run it through all of the big banks, and they determine how much that would impact their capital. And then that leads into a number that's called the stress capital buffer, which actually becomes a component of the required capital for the bank. So it's essentially saying if that adverse scenario plays out, your capital would decline by, say, 4 percentage points. We're going to make you hold 4 percentage points of additional capital beyond the other components of the minimum threshold of capital.
Because, of course, we forget banks are leverage creatures, aren't they? They have these big imposing headquarters. But if there's a loss of confidence, there's not that much capital in there supporting a vast edifice of loans.
Right. Yes and no. It's important to keep in mind that capital requirements for banks are there to reflect unexpected losses. So expected losses, like banks are always provisioning for loan losses, depending on the economy. Those are already baked into earnings, which flow through capital. And so the capital they hold is for unexpected losses. So these adverse scenarios that the Fed comes up with are pretty severe. It's looking at things like a 50% drawdown in the market, GDP decline of something like 9 or 10%, unemployment of 10%, and how all of that feeds through.
No, those are pretty severe. Yeah. I guess just the shareholders' equity as a percent of a bank's asset base is pretty tiny. But of course, they have deposits, they have liabilities. Right. Yeah. Are you expecting any big changes from the regulator?
Yeah. So the one change this year is the adverse scenario that they're running with. It actually looks a little bit less adverse than it did last year, and so we expect that to flow through into sort of lower stress capital buffers across the board for the banks. Disproportionately, that stress capital buffer sort of disproportionately affects the capital markets banks in particular, like the Morgan Stanleys and Goldman Sachs of the world. They both have to hold capital above and beyond their peers simply because the markets business tends to be riskier than traditional lending. So we should see some relief there with the results coming out this Friday. We're also fairly optimistic that we're going to start to see some changes on the regulatory side. So we've heard all this regulatory relief coming from the Trump administration. There are sort of 3 broad components where we could see that. One is on the stress capital buffer, where one point of contention with the banks on that is that that's a variable component of their capital. It changes each year. And so the market, I think, widely expects that the Fed will start to allow them to average changes into that over a couple of years and then defer implementation by a further 3 months. Right now, they would have to implement it by October 1st. You could see them potentially delay that until January 1st. Another change we expect to see is on the other big component of capital for the large banks is this GSIB surcharge to reflect these global systemically important banks. Sorry, a bit of a word salad.
Right.
Their interconnectedness and whatnot. And so one of the issues with that component of required capital is that when it was originally designed after the financial crisis, it didn't really reflect the fact that the economy was going to grow. And so as the banks have gotten bigger, they've been required to hold more and more capital because they're bigger without really reflecting the fact that banks just get bigger as the economy grows. So it's become this growth problem. So we largely expect the Fed and other regulators will address that problem this year as well. That will start to flow through in terms of lower required capital for the banks. And then the last one, of course, the supplementary leverage ratio, which is, when we talk about capital for the banks, they're holding capital against what we call risk-weighted assets. So you have to hold more capital for, say, a personal line of credit, which might be riskier than a treasury bond, which is risk-free. They also have to hold the supplementary leverage ratio, which reflects their total leverage, as we were alluding to earlier. And there's some changes essentially coming there that may allow them to lower that number or potentially exempt treasuries from that calculation, which would be positive for markets overall. And I think something the Trump administration would be on side with, just in terms of helping support the treasury market, especially in terms of there's a crisis.
And of course, the less capital banks have to set aside, the more profitable they are, or certainly in return on equity and return on capital.
Yeah.
You have some ideas for us. M&T Bank, why do you like the look of that one, Mike?
Yeah, so we like that. So I think they're going to be one of the key beneficiaries from the stress test coming up. So because of their size, they're not quite in the largest group of banks. They're only required to do the stress test every other year. They've actually volunteered themselves to do it this year, which is a pretty good indication that management is optimistic with the results. We think they've done a pretty good job in terms of right-sizing some of their commercial real estate exposure, which led to some provisioning issues over the last couple of years as rates went up. And that should feed into sort of better results on their stress test. But I think what the market is really misunderstanding or on M&T Bank is that their ability to actually buy back shares and the speed with which they can do it. So we think, you feed all this in, they've got excess capital, their required capital is potentially going down. We think they can probably buy back something like 15% or more of their stock over the next 18 months.
And they're stepping up for the stress test. Give us one more idea. Morgan Stanley, we're tight for time. Sorry, Mike.
Morgan Stanley, again, key beneficiary from all this regulatory change on capital rules, as well as, take your pick, Morgan Stanley, Goldman Sachs, we like them both. They both have exposure to capital markets theme. We think there's a pending boom in capital markets activity in the economy that got a little bit deferred by all of the issues around tariffs and whatnot. But now that the markets are back at or near all-time highs, we think a lot of that activity comes back. I think there's a lot of pent-up demand for M&A activity, which has been running sort of 30 to 40% below long-term averages. IPO, ECM, like equity capital market activity, running more like 50% below long-term averages. So as that activity comes back into the market, Morgan Stanley is a key beneficiary of that and should flow through to positive earning results and, again, return of capital to shareholders, which is a key theme across the whole financial sector.